The dot-com bubble in 1999 and 2000 was a pretty weird time in the stock market. If we look back at some of the valuation metrics for the US market at that time, we can see that things got to some pretty high record-breaking figures on things like a simple PE ratio. And what's really interesting to me about that time is that it's not like every single stock in the market was overvalued in 1999 and 2000. It was primarily driven by many of these dot-com companies, a lot of which had recently gone public, some of which didn't even have a business model. And although there were profitable companies in that mix, like Microsoft, even those really good companies took a long time to grow into the valuations that people were putting on them in 1999 and 2000. And interestingly, the further that you kind of got away from the pure dot-com startup type business, the less extreme the valuations actually looked. And in many cases, some of the stocks might have even been cheap. I mean, if we look at the day that the NASDAQ peaked, which is an index in the US that is full of technology companies, the day of the NASDAQ peaking aligned pretty closely with when Berkshire Hathaway hit a 52-week low in 1999 and 2000. So there was a pretty clear spread between the most expensive stocks in the market, the glamorous dot-com companies that didn't produce any cash flow but had all these promises of growth, and the more stable, cash flow producing companies like Berkshire Hathaway actually had some very modest valuations at the time. And in many ways, I think there's some pretty similar kind of trends in terms of that value spread between what was happening in 1999 and 2000 and what we've seen in the last couple of years, where we've had the unprofitable tech indexes and that sort of thing really explode upwards. Of course, they've come back to earth a little bit recently, but in this video, I want to dive into some of the data around how the value spread kind of sits today. And this may sound familiar to long-time subscribers of the channel. I have been covering the value spread, which is published by a value investing firm by the name of AQR, for a couple of years now. I actually made the first video on this topic in 2020, where the value spread was just stretched to basically dot-com bubble type levels. And since then, we've obviously seen, all these unprofitable tech companies really decline quite substantially. So I think it's an interesting time to give an update on where the value spread sits today. So that is the topic for today's video. If you do enjoy it, be sure to hit like and also subscribe to the channel if you are new here. But for now, let's get straight into the video. Now, before we get into the value spread specifically, I firstly just want to look at some of the overall kind of valuation metrics for the US market. So I'm going to jump over to Simply Wall Street here. This is a website that I've been using increasingly for a lot of my initial stock analysis, getting some basic stats on the companies, looking at analyst forecast of earnings, insider transactions, that sort of thing. And Simply Wall Street does have a nice sort of market section where we can basically look at some of the overall market valuations. So let's start out firstly just by looking at the aggregate kind of price to earnings of the US market, and we can see that as of recording this video at least, we currently sit at about 24.9 times earnings, which is actually a little below the 10-year average of about 26.3, and it's pretty substantially down from, a year or so ago, where we got up to about 54 times earnings, at least in aggregate. So this is looking at sort of the total market cap versus the total earnings in the US market. And if we scroll down a little bit here, we can see kind of the factors that have driven that change in price to earnings. We can see what the total revenue has done, we can see what the total earnings has done, and we can see what the market cap has kind of done over time as well. But that's sort of where we sit on an overall price to earnings basis. If we jump to a median price to earnings basis, I think that's where things actually get pretty interesting, because it seems as though a lot of that still relatively high price to earnings of north of 20 is really driven by a lot of the biggest stocks in the market. Those are the ones that tend to have the most weight in things like an S&P 500, and they can kind of pull that average PE ratio up or down depending on their market cap. So if we go to the median, things actually look substantially more reasonable in terms of valuation, and the median price to earnings is now about 15.7, which again is below the 10-year average of about 17.7. If you do want to check out Simply Wall Street, it's free to use forever, but there is a link down in the description that will get you a 30% discount if you do sign up for one of the paid plans. It doesn't just give things like PE ratios, it does also provide sort of some context around things like a PE ratio. Take my beloved Thor Industries, for example, that trades at a very modest PE at the moment. But if we look over on Simply Wall Street, we'll see that earnings are projected to decline in the next couple of years. So you can get some context around those things. Whether those pesky analysts are right with Thor or not, we will see. But that is the first link in the description if you want to check that out. So looking at some of that initial data from Simply Wall Street, that tends to suggest to me that there probably is a bit of a spread in valuation. We're seeing the average at north of 20, the mean, and we're seeing the median at more like 15. So there is clearly a spread, and if we jump over to AQR's latest data, and this has just come out on the 5th of August, we can see that the value spread, although it compressed quite a bit in the last few months, has kind of started to grow back upwards again. And Cliff Asness, who's kind of the main guy, pretty famous value investor, billionaire, kind of runs AQR, has titled this update on value spread, value spreads are back to tech bubble highs. Is everyone out there cray-cray? And Cliff Asness basically comes to the conclusion that yes, people are in fact cray-cray, and we are back to the 98th percentile in terms of value spread. So this is just comparing the most expensive stocks in the market to the cheapest stocks in the market, and there's still a very, very wide gap between those different baskets of companies in the market. Now, in previous kind of value spread update videos that I've dug into, Cliff Asness has tried to, explain all of the different reasons why this may or may not be justified. He's looked at, historic earnings growth for the companies that have high valuations, the projected earnings growth. He's looked at other metrics like, using enterprise value or using price to book. And they basically all come to the same conclusion that this value spread is probably not justified. So to me, although I don't tend to get very macro very often, this is probably about as macro as you'll ever see me get, it does suggest to me that at the very least, if you are looking to kind of hunt through individual stocks, looking down that, quantitatively cheaper end of the market is probably not a terribly bad place to start. And to be honest, I was kind of surprised to see that the spread hasn't sort of closed more than it has. I mean, we've seen the likes of ARK, which is kind of the poster child for high-flying, high-valuation tech stocks and that sort of thing, come down substantially. I'll put the kind of stock price for the main ARK fund up on the screen here so that you can see that. And even with all those substantial price declines and many kind of unprofitable tech stocks being down 70, 80, 90%, we still haven't had the spread close all that much, and it's actually started to kind of stretch out again, which is pretty interesting to see. Now, one final factor I did want to mention that impacts the valuation of any asset, and stocks are certainly no exception, is of course interest rates. And we've seen more and more news this year about rising interest rates in order to kind of hopefully stem inflation, which unfortunately hasn't been too successful, so far, but hopefully we'll be able to sort that inflation problem. Interest rates, as Buffett has said many times, are like gravity on stock prices, and the way that kind of works mechanically, you can think about it a little bit like a discounted cash flow, or exactly like a discounted cash flow. Now, a discounted cash flow is basically looking at how much cash a business produces today and how much it's likely to produce kind of each and every year moving forward. And basically what a discounted cash flow is trying to say is that, if I get paid $1 today, that is more valuable to me than getting paid $1 in 5 years' time or in 10 years' time. I have to be paid, some sort of return in order to wait around for those future dollars. And the return that investors demand is very strongly linked to interest rates. And that basically means that as interest rates rise, those back-end kind of further out cash flows suddenly become less valuable. And it's not just those faraway cash flows that become less valuable, it's, all cash flows become less valuable. The cash flows that show up in year 2 are less valuable. It's just the ones that are 5 or 10 or 15 years out, those ones are impacted a little more, or a lot more, I should say, than the closer kind of end cash flows. And that tends to be something that, in terms of relative performance at least, is pretty good for value type stocks. If you think about the traditional low PE or low price to book company, they tend to be slow growing, maybe they pay out a lot of dividends, do a lot of buybacks, they produce a lot of cash today, there's not a whole lot of promise of growth in the future. So those companies tend to be hit not quite as hard by increases in interest rates, and the kind of holdings of the world do tend to be hit pretty hard. Now, all of that said, I think we've got to look a little bit at the broader context. The 10-year bond in the US is a little under 3% at the moment as of recording this video, and that's really only getting us back to 2018 levels. We've kind of been in like a 30-year bull market for bonds where interest rates have just come down from the Paul Volcker days of the 1970s and 1980s, where interest rates were like 15%. So in the grand scheme of things, interest rates really aren't that high. But of course, when you're coming off basically zero, it can be a little bit of a shock to investors. So is Dotcom bubble 2.0, as I was calling it in some older videos in the last year or two, over? Anecdotally, it kind of feels like it maybe is. Maybe we're out the other side of it. When I look around, I see a lot of beaten up companies. I see a lot of people who had heavy allocations towards unprofitable tech and high growth companies be pretty substantially in the red in their portfolios, but the value spread suggests that we're still maybe not quite there, and we might even be a long way from being fully back to a normal kind of spread in valuations of these companies. So it will be an interesting one to continue to follow. If you've got thoughts on this whole value spread situation, definitely let me know down in the comments below. And if you want to see future updates on the value spread as AQR continues to publish this data, let me know. If you want to check out the original article, that is always linked down in the description below as well. But that's it for me for this one. If you did enjoy the video, be sure to hit like and also subscribe to the channel if you are new here, and I will see you in the next video. Cheers.